just said that God is dead. I'm saying that the bank account is dead. And what replaces that is a token on a public blockchain in a wallet. And that token is money.
Money is a utility, but it is a sacred utility in a lot of ways, right? It's a defining utility in a lot of ways too.
People say quantum computing breaks Bitcoin. Well, quantum computing breaks traditional finance a lot faster than it breaks Bitcoin.
So ladies and gentlemen, welcome to today's episode of Couchonomics with Arjun. I should sort of call this a special one because not often do I get the godfather of cryptocurrency, David Shom, reaching out to me and saying, you must have this person on your show. And then I read up on the gentleman who I'm soon going to introduce, and I couldn't make heads or tail about what he was talking about. So that kind of was a challenge. So it took me a month to sort of get myself up to speed. But in any case, this is a long introduction. I want to welcome Tony McLaughlin, who I have horribly sort of messed up with the name. But Tony, welcome to the show. I know you're beaming in from London.
Thanks. I am.
So Tony is actually the founder and CEO of a company called Ubyx, and we will get into Ubyx very shortly. But Tony, you come highly recommended. David doesn't usually pick up the phone and call me and say, here's a person we must have in the episode. You're the first one he's done it with. My only request is just be fair on us and our audience and try and keep the conversation where we all can understand what's happening in the world of digital assets, because a lot of people are in this sort of little sort of world of their own, right? And you guys are solving some big problems with some amazing solutions, but sometimes we kind of miss a trick in terms of translating it for the many. So Tony, let me start with a very basic question, right? I think a scene setting question is very interesting. Is where are we today? With this whole digital cash. Stablecoins, CBDCs, tokenized deposits. What's kind of the state of the nation? What's actually changed since sort of 2021?
Since 2021. Okay. So I think back in 2021, probably the biggest thing that had changed up until that point was really the development of Fintech. And, I know that you're very much into the Fintech ecosystem, but let's ask yourself, what is Fintech? Fintech is a layer on top of the banking system, right? There's no Fintech that's moving money that isn't dependent upon the banking system, the traditional rails. All of the biggest Fintechs, all of the coolest Fintechs have got multiple banking relationships. They access ACH, faster payments, SWIFT, and all of these traditional rails. But they provide obviously a much more agile and better design and customer experience, and they move much faster than the traditional banks. So this is all fine, but then running along in the background is another thesis, and this other thesis is that we shouldn't have special purpose technologies for payments. Now, I don't want to speak in hieroglyphics, but the emergence of blockchain is the emergence of a general purpose technology for deciding something quite important, which is who owns what. I think the best definition of a blockchain is it's a who owns what machine. Now, in our funny little human society, at the very depths of our psyche is this thing called property. And, back in prehistory, we had this idea that rock is mine. Arjun, don't touch my rock. And then we developed laws. A lot of the laws that we developed were about property. This thing is mine. That's yours. And we can do contracts, we can exchange things together, but it's really based upon the Lego blocks of property. So who owns what is super deep in our psyche. I mean, the fact that you think you own your microphone and your T-shirt, these are really bizarre concepts. These are just atoms. what does owning it really mean? But it's important to us puny humans. So along comes this technology called blockchain. And the reason why I think it really hits our psyche, and it's really deeply, it triggers something deep in lots of people, is blockchain is a who owns what machine. That's something we care about very, very much. Now, with the development of Bitcoin, you've got a special purpose who owns what machine, because the only thing that Bitcoin keeps track of is who owns Bitcoin. And then along comes Vitalik from who knows which planet, who knows which dimension he's from. And he generalizes the who owns what machine. He says, hey, humanity, here's a machine where you can have tokens on a general purpose computer. And these tokens can represent anything that you care about. So do you want the token to represent your pet rock? No problem. Do you want the token to represent your microphone? No problem. I'm giving humanity a general purpose who owns what machine. This is, again, the thesis came in the 2000s, in the early part of the new millennium. But we've obviously had a legacy system in the financial system where we've built very, very special purpose rails for who owns what. So what is your bank account, Arjun? Your bank account is just a record that your bank owes you $100. It's a special purpose. It's a very, very narrow who owns what. And what generally tends to happen, Arjun, in the history of technology is that the general purpose technology takes over the special purpose technology. That's why you probably don't have an alarm clock next to your bed anymore. You probably don't have a pocket calculator. You know, your phone has replaced your Walkman, because the general purpose technology, if given half a chance, sweeps away or subsumes the special purpose technology. So I think what's new since 2021 is that the general purpose technology now has its chance to shine. And if history is anything to go by, over the medium term, this general purpose who owns what machine will subsume the features of ACH, faster payments, cards, SWIFT, and all of the special purpose legacy payment rails that we've lived with up until this point.
No, it makes sense, Tony.
Am I going too abstract?
No, you're not going too abstract. But just staying with that philosophy, I take the example of the phone replacing multiple, if I may say, devices which had features which have all been combined. But when we come to the world of money, obviously, the paradigm shifts, right? It's no more about a utility. Well, money is a utility, but it is a sacred utility in a lot of ways, right? It's a defining utility in a lot of ways too, right? And regulation comes in and policy comes in. And doesn't that regulation and policy then drive us away from general purpose towards special purpose? And maybe there's a halfway house, but isn't an element of that regulation is the reason why some of these special purpose stuff will always remain special purpose? From a tech perspective?
Yeah, I mean, that was certainly the case in my previous life when I worked in TradFi, because the regulators had placed a very, very large sign on the lawn saying, keep off the grass. And that lawn was the public permissionless world. Keep off the grass. That the complexion of or the art of the possible changed with the US election, like it or not. That's the change. And the keep off the grass sign has been removed. Now, what you still see is people who have been told for years and years to keep off the grass, very careful, very tentative about stepping onto the grass. But they will occupy that space. And there is a thesis, and you must come across that thesis as in your work. The thesis is that all finance is going on chain.
Mm-hmm.
Do you encounter that thesis that all finance is going on chain?
Well, I think all finance is heading towards getting on chain. Whether all of it will go on chain, we'll sort of wait and see, right? But the thesis does stand on its own merit, if I was to use that term. Whether adoption does, I think time will tell.
But you would agree that there's a wave of capital and talent who are prosecuting that thesis that all finance is going on chain.
No, without doubt. And I think this is where I was going to ask you the next question, which is has stablecoin become sort of that happy middle ground where stablecoins, which have sort of dominated the airways, if I may use that term, over the last sort of 12 months in terms of the poster child for DeFi, right? Yes, Bitcoin is everyone's most interesting conversation, but it's more of a, how do I say, it's a speculative tool. People just want to talk about how people should just put all their money into Bitcoin and stuff. I don't know if you get a chance to speak about it. We'll come to that later, but let's talk about stablecoin. Is stablecoin sort of the middle ground? Is it the happy ground in the middle where regulators, skeptics, right, believe that fine, I think this looks good enough, we can regulate it, we can peg it to a currency, and then the world of the decentralized world, the people who want to sort of prophesize the on-chain say, okay, well, this is great because, we can start moving money around, especially sort of large sums. Yes, 60-70% of DeFi is still, the stablecoin is still used in the DeFi world, but we're starting to see use cases migrate. So is it the happy ground? Is it the happy middle ground?
All the way back to the origin of Bitcoin and the white paper, it was about a world with no intermediaries. Censorship, resistance, anonymous or pseudonymous peer-to-peer transactions, no intermediaries, no issuers, and code is law. It's that founding ideology is a refutation of the ability for nation states to manage money in a responsible way. So then, if you fast forward and you say that the use case for this technology, for the blockchain technology, is actually to manifest the next generation of fiat currency, you're already far from Kansas. I mean, you're not in the Bitcoin maxi camp if you think that the best use of this technology is to express fiat currency. So we can't. I'm not even sure that you can claim with a straight face that stablecoin is crypto because of that departure, because crypto was about getting rid of fiat currency. But nevertheless, the utility of these general purpose tokens is a natural fit with fiat currency. And indeed, wouldn't it be ironic if the outcome of Bitcoin white paper, going through a number of evolutions, was the perfection of the fiat currency system? Wouldn't that be deliciously ironic? So Libra came around, I think, in 19. Why was Libra destroyed? Libra was destroyed because a group of non-state actors presumed to have their own central bank. And the nation states of the world said, no, you're not having your own central bank, because having your own central bank is no different from having your own law or having your own military. And I'm sorry, big tech, you can't have those things because they belong to the nation state. So then stablecoins, there are aspects of stablecoins that the nation state won't love, like them circulating on unhosted wallets or self-custodial wallets, but they're pegged to the sovereign currency. Mm-hmm. And so that part of it is fine. So we're at this point where nation states still see stablecoins as crypto assets, but they might shortly just say, you know what, a stablecoin is nothing more than a new form factor of fiat currency. And that's where I think we're heading. I think we're heading to a place where we used to have checks, We used to have credit cards. We used to have debit cards. We used to have ACH. We used to have we used to have bank accounts. Nietzsche said that God is dead. I'm saying that the bank account is dead. Mm-hmm. And what replaces that is a token on a public blockchain in a wallet. And that token is money.
So taking that view, right, as you just said, stablecoin is just a new form of fiat, right, or a token form of fiat, using my words. How do you see things like CBDCs then, right? Because CBDCs is, in my view, the true form of sort of digital fiat, right? Fine, it rides on blockchain and uses some of the newer rails, if you might want to call it. And then, there's this tokenized deposits play too, which some of the banks are, at least some of the large banks are playing, rightly or wrongly, God only knows, right? Things will play out. So two parts to the question. How do all of these coexist? Or are we just going through a period where a number of these will coexist and then some might actually, go into sunset? I don't think that'll happen with CBDCs if banks actually if governments really go out with them, because as you use the word, currency is a form of control. At the end of the day, that's what governments and nations are most worried about, right? And therefore, we always have this conversation around, how dollarization is sort of, how are stablecoins driving dollarization. And then the second question, if I may ask, if all stablecoins is just a new form of fiat, then what's all this rhetoric around stablecoin is infrastructure, not a form factor, right? So do you fundamentally disagree with that? And again, we don't want to make this too conceptual a conversation and spend the next sort of hour discussing that. But, just to kind of hear your view, because you're the first person who's come in, and I've had everybody from anybody come on the show, but nobody has yet used the term that stablecoin is basically a new form of fiat, right?
Arjun, I think you would probably agree with me. We might be approximately the same age. That age is an asset and a liability, right? And
I don't know where this conversation is going, but all right.
Here's the thing: a stable coin is an old instrument wearing new clothes. What is the old instrument? We can go back to prehistory. I owe you. I owe you, right? Back in the day, I can, if you give me $10 and I write on a piece of paper, I owe the bearer of this piece of paper $10 payable on demand, signed Tony, and I give that piece of paper to you, Arjun, then you can do two things with it. You can bring it back to me and claim back your $10. Or you can sell it to someone else. And when you sell it to someone else, that makes that IOU something called a negotiable instrument. Now, humanity have had negotiable instruments into antiquity. So here's the question. If I take your $10 and I write IOU on a clay tablet, is the legal instrument different or the same as if it's on paper?
I would say different, no?
It's the same.
Why?
Because whether I write it on paper or clay, I owe you means I owe you. I owe you.
But on a $10 note, right? Versus a clay tablet. You're just a piece of paper.
Sorry, you've given me a $10 note. I put it in my pocket, and then I write on a piece of paper, I owe you.
Okay.
So I hand over to you the piece of paper. And I mean, surely you would agree that if I write it on paper or I write it on clay tablet, doesn't make a difference, right?
Yep.
Okay. Now let's say that instead of on a clay tablet, I record that liability on a relational database. Does it make a difference?
No, it doesn't. It's just, I guess it's more assured, but no, it doesn't. It's the same stuff.
Okay. So now I record that IOU as an ERC20 token on Ethereum. Does it make a difference? No. It doesn't. The technology that I use to record "I owe you $10" is arbitrary. I could record that on some kind of yet to be invented holographic recording device, and it wouldn't make a difference. So the IOU is something that lives in a utopia. It's independent of the form factor. So these IOUs, previously they were transacted in meat space in the physical world. I would mail it to you, right? I mail you a check. That's just an IOU. Or I can, the form factor is paper, and now I send you a token. Nothing has changed. So stablecoins are an IOU from a non-bank. Now, let me take up your CBDC. If the central bank writes you an IOU, it's the same thing, right? It's just that the central bank is promising to pay you back. That's what we call a CBDC. If a bank creates one of these IOUs, it's what we call a tokenized deposit. But the way of understanding these things at their root is we're merely creating IOUs using a new substrate, using a new technology. But the nature of the instrument is ancient. IOU. So then you ask the question about stablecoins: are they a new form factor, or are they a new infrastructure? Well, the infrastructure is the general purpose infrastructure of tokens, which can adopt any features we want them to on public blockchains. That's the infrastructure. The stablecoin is an application of that general purpose infrastructure. That's the way that I see it. And the application is to record the IOU from a non-bank, fully collateralized non-bank.
Okay. No, it makes perfect sense, right? So, and that's pretty much how a lot of us sort of came around to understanding this. So, and then there was, I guess, over intellectualizing, which actually happened, right? But then let me sort of put a real world problem, and I think this is where I possibly think Ubyx comes into the equation. We start talking about Ubyx is. So you're going to have these multiple forms of IOUs which are going to exist, right? Which are going to be built on, as you said, general purpose infrastructure or general purpose technology. But a number of people are building these highways, right? If I was to call them our infrastructure, right? Interoperability in the fiat world, to a large extent, has been resolved very poorly, clunkily, but we have a method behind the madness. It's expensive, it's inefficient, it's slow, right? Here, as long as you remain within a particular walled garden, it's quick, right? So there's better immutability, there's better, I guess, speed. And so therefore, yesterday, earlier this week, I was actually speaking to a big payments player, and he said, using stable coins to move B2B payments cross-border has taken down my cost by about 40% and increased my efficiency by 3x. And he said, I love it. And he's like, I'm going to continue adopting as long as it goes ahead. So how do we get over this interoperability sort of challenge? And does Ubyx sort of fit in that sort of wider dialogue?
Yeah, I mean, when we had IOUs written on paper, we called them checks. And we had many issuers and many receivers, and we built a clearing system and we resolved it. When we have banks running their own relational databases, we've got many banks on the sending side, many receiving side. We build faster payments and ACH. We build a clearing system and we resolve it. When we have credit cards that can be used, how many issuers are there of credit?
God knows.
How many issuers are there of credit cards? 16,000.
Well, thank you for educating me. I was going to say tens of thousands, but there you go.
No, but Arjun, I mean, you could say, what? We've got 16,000 credit card issuers? That's so much fragmentation. Where's the fragmentation? Anyone can take any credit card into any shop. There's no fragmentation. Because we built Visa and Mastercard. So believe it or not, the market structure for stablecoins there will be thousands of issuers, millions of accepting points, and there will be no fragmentation.
And do we really need thousands of issuers? That's my whole question.
Why don't ask the same question, which is, do we need thousands of credit card issuers?
But why don't we learn from our mistakes?
Well, it's not because it's not a mistake, because every single one of those issuers is a balance sheet. And that's good. It's very big diversity. That's very big diversification. So once in checks, we built a clearing system. In ACH, we built a clearing system. In cards, we built a clearing system. And all I'm doing is building a clearing system for stablecoins and tokenized deposits and CBDC and money market funds. The tokens have to clear in the same way that the previous form factors did. And the emerging market structure will be very pluralistic. Here's the vision, or the world that I think we move into. Your bank or fintech will give you a wallet. I'll be able to send you any stablecoin, any tokenized deposit, any CBDC into that wallet, and your bank will be able to convert that into your bank balance if you want them to. That's it. That's how it's going to work. And the reason why every bank in the world is going to do that is because, sorry, Arjun, you live in Dubai, right? Okay. So if I send you a US dollar stablecoin and it arrives into a wallet provided by your bank, and your bank converts it to local currency, what does your bank make?
That makes money on the FX mostly.
FX for banks and fintechs is what in previous times, when we had traveler's checks, everywhere in the world accepted traveler's checks because the recipient made FX. So stablecoins create the same dynamic. Your bank is going to offer you a wallet. Your bank is going to enable you to accept tokenized money in dollars and other currencies because your bank loves FX. You can take this to the bank. This has already happened. It has just yet to unfold.
So the concept of clearing, right, has existed for a while. We've been clearing checks. We've been clearing, as you said, credit cards and so on and so forth. But if you see the origin stories, they're quite interesting, right? So either they're state-funded or state-run sort of exchanges or clearing houses. Obviously, a lot of people don't know how Visa and Mastercard actually came into being, which were actually consortia of, banks coming together. It was supposed to be a not-for-profit entity. And then, one fine day you you turn the switch and you've got two of the highest valued sort of fintechs in the world, which are existing, which were built on, some level of subsidies and so on and so forth. So, honest question, how do you see yourself pull it off, right? As being a sort of a founder by yourself, right? Are you building this consortia? Are you kind of, going around and sort of bringing all these so-called stablecoin providers or digital assets players to say, come co-invest and sort of build this exchange with me? Or maybe you don't want to answer that question.
No, I do. I do want to answer the question. I published a white paper and I said, here's what has to happen for there to be a healthy stablecoin ecosystem. That white paper, I think, is just true. What's a thesis? I think it's true, based upon history and based upon just the incentives that are across the ecosystem. And then I raised money, and then I build a team, and then I build a product, and then I go on lots of podcasts, and then we see what happens. But
how's the world reacting to you? So not just the biogenerers, so people who need to become a part of this nexus. So are they still sort of holding back because a lot of them are investing in their own infrastructure, right? Including some of the stablecoin players who are not only building payment systems, they're even building their layer ones and so on and so forth, right? So generally, are they receptive to this idea? They will see you as a hedge and say, okay, well, we'll kind of play with this side also, because if our strategies don't play out, this is a more universal view, or are they really doubling down and saying, Tony, we want to work with you, we want to create something which is like Mastercard for stablecoins?
Well, I look at interests, So what do issuers need? Issuers need a mutualized acceptance network. They cannot build it by themselves. It's too expensive to build a distribution network by yourself. What does the American government need? They need a distribution network for their stablecoins. Otherwise, they don't diversify demand for their treasuries. What do banks outside and fintechs outside of the US need? They love to make FX. So there's a very strong driver for your bank to open a wallet to receive stablecoins and make FX. What does the central bank governor need? The central bank governor needs the stablecoins to arrive in hosted wallets, because if they all arrive in unhosted wallets, they're not visible to the tax system. So there's a set of needs out there that are beautifully satisfied by the existence of a stablecoin clearing system. And I will attempt, with my limited powers, to bring such a thing into being. And time will tell whether I'm successful.
Cool. 3 questions now. I've got like too many questions, but let me ask them. So first is about stablecoins, right? So what do you think are going to be the couple of use cases in the near future, which is going to kind of drive sort of hyper adoption, right? In terms of, if I may call, the traditional commerce, the world which is not just about DeFi exchanges and moving world in DeFi, right? So that's the first part of this question. Second part of the question here is without doubt, building the mutuality which you mentioned is not inexpensive. But do you think there's going to be sort of heavy resistance from some of the bigger players who are getting more rapid adoption, right? And no names to be taken, but everyone can sort of guess, right, who they are and are they going to resist it? And thirdly, have you already got an offer from Mastercard or Visa to buy you out? You can answer the last question in whichever way you want to.
In any way, shape, or form. So, look, use case. Everyone asks for the use case. Let me just give you the biggest use case in the world. There is, again, we'll do it on a no names basis, but let's say that the biggest e-commerce company in the US, their sales, let's imagine that their sales, last time I looked, their sales were $350 billion. Only in the US. So what percentage of that do you think, what percentage of that stuff was made in the Far East?
Well, till the tariffs came on or after the tariff? No, vast majority, I would imagine. Well, vast majority.
Okay, yeah. Right. Okay. So let's say that there's $300 billion worth of goods being made and shipped into the US and sold on an e-commerce marketplace. Now, let's say that e-commerce marketplace said, from now on, I'm going to pay the supplier in my own stablecoin. Would that be a good idea for the marketplace or a bad idea for the marketplace?
Well, I would imagine it's a good idea. It includes a certain loan.
It'd be a beautiful idea for the marketplace, because let's say that the goods come into America and they send the dollar stablecoin to the factory owner in Vietnam, and then the factory owner in Vietnam says, "Oh, this is interesting. I've now got a dollar balance. So what I'm going to do is I'm going to convert half of it to Vietnamese dong and pay my workers and my local my local expenses, and half of it I'm going to keep in dollar stablecoins. That's interesting. Now I've got access to hard currency." And on the e-commerce marketplace side, they say, "Okay, this is interesting. I'm now sending $300 billion out. And previously it was just gone. But now half of it remains on my balance sheet. And half of it I'm earning 4%.
Yep. And you can add layers of programmability on it. So
like Arjun, what I've just given you is the total market cap of stablecoins is 250 odd billion, whatever it is, 270. Right. This one e-commerce marketplace can become the biggest stablecoin issuer on the planet within 18 months. This is, so people ask me for the use case. This is
cross-border B2B payments, right? I think so. You think that is the silver bullet then?
That's just one very, very obvious one. But this applies to many countries. My country is the United Kingdom. Guess how much we import every year from overseas? We import $1.3 trillion worth of stuff from overseas every single year. So some proportion of that can be paid in GBP stablecoins. Is that a good idea for Britain? Yes, because those, to the extent that then from UK, we're sending GBP stablecoins to Vietnam, and the factory owner in Vietnam says, oh, I can now hold GBP. That's interesting. I don't want all my money in dollars. I'm going to have some of my money in GBP. Then what is that factory owner in Vietnam doing? They're funding GBP, the UK national debt. Beautiful. So there's a very, very, very strong incentive on the sending side. And there's an equally strong incentive on the receiving side, because lots of people around the world would enjoy having access to hard currency in portable format in a diversified way. So that's the first part of the question, which is to do with the use case. The middle one, I can't remember the question. The third one I do remember, and the answer is no, not yet. And we're not for sale anyway. We haven't even gone live yet.
No, I know you haven't, but sometimes the best ideas are bought before they're actually going live, right? And I think we have a history of that over the last sort of 20 years, at least from the big players.
Arjun, if you ever see me selling out to one of these players, I give you permission to slap me in the face.
No, I do not want to slap anybody, including yourself. And if you're able to sell yourself for the hard work you put in. But no, I think, so well answered in the first one. Let me give you a variant to the second one. So wholesale CBDCs, right? We're starting to see some pilots happen there, right? We've had something called, I think it's called Mbridge. There's Nexus, so on and so forth, right? Where do you see this gets balanced with stable coins? And are you going to, do you think that stable coins will kind of win the race because of exactly the same reason that you mentioned, that, if you're the biggest marketplace in the world, you want to have your own stable coin because you can then, make money on it, and maybe on wholesale CBDCs that use case doesn't fly?
These things don't live in the same venues. A wholesale CBDC is just a tokenized version of a real-time gross settlement system.
Okay.
And they really kind of exist at national level, and they're to do with wholesale settlements and central bank money. They don't live in the same place. And this is another great confusion that people have. So I hear this in Europe. People in Europe say, well, the Americans are going to send their stable coins, and so therefore let's do the digital euro. I mean, this is bonkers. These things don't live. These things pass each other in the night. They don't live on the same network. If Europe really wanted to compete with the American stablecoins, Europe would launch dollar stablecoins. So there's, I don't know. This is something to do, I think, with the translation that we need to make from the physical world to the digital world.
And how do you expect Europe to respond then, right? Because there is a growing concern in Europe regarding the USD stablecoin, I guess, nexus, if I may want to use that term, right? Because what you're saying is, to be honest with you, not that hard to comprehend, right? Even someone like me can. So how do you expect, because I'm sure the policymakers will respond on it, at least in Europe quick enough, in the UK quick enough. What do you see is happening? Do you see a Euro stablecoin or a GBP stablecoin?
So the appropriate response requires a small mindset shift to which, when explained, should be blindingly obvious. American stablecoins are a gift. In the same way that American travelers' checks were a gift. American stablecoins come into Europe. If they are captured within the European financial system and converted to euros, they're a gift. The banks and the fintechs make FX, and they're captured into wallets provided by regulated entities, and therefore they go through AML and KYC and sanctions. So if I were advising the powers that be in Europe or in any other country in the world, I would call up the CEOs of the banks and the fintechs, and I would say to them, please catch the foreign stablecoins into wallets and convert them into FX and convert them into local currency. And there are actually 6 words that make stablecoins a gift. Banks can process stablecoins like checks. In every country, in almost every country in the world, you can take a dollar check into a local bank and deposit it. I can take a dollar check into a bank in Dubai and deposit it. Now, here's something super interesting. Dollar checks are not regulated in Dubai. The issuer of the check is not regulated in Dubai. So if I can take a dollar check into a bank in Dubai and it can be processed today, I can take a dollar stablecoin into a bank in Dubai and it can be processed tomorrow, just like a dollar check. Now, that turns the American stablecoin from a threat into a gift. The more they send, the more FX is made by the banks and fintechs, and the more the money ends up on the local balance sheet. So, again, age and spending. I spent 30 years in TradFi, and I come at this from the perspective of what happened in the age of checks, what happened in the age of ACH, what happened in the age of cards, and now what's happening in the age of stablecoins. And forgive me for not looking at stablecoins as if we've invented fire. Forgive me for just seeing them as a new form factor of things that we've seen before.
Okay.
And I don't know what's wrong with the regulators, that maybe they've been blinded by science. And when the crypto guys come at them and say these things are completely new to the world, the regulators believe them. But my view is that they are old instruments in new code.
No, so because of the line of work I'm in, right, I kind of get to see that paranoia, confusion, whatever the right word here is. And I think that in my humble opinion, there's 2 or 3 factors. I think one is they were obsessing over the technology rather than the application of the technology. And I think a lot of central banks didn't get it, where I think what they should have done is understood the technology and regulated the use case. And I think life would have been easier. That was one. Secondly, I think in the initial period, there was this sort of laissez-faire attitude towards, we're here to sort of shut the central banks, and, the world is going to be taken over, and, the crypto bros and the NFTs and all of that shenanigans, which actually happened, sort of took the air, sort of the airspace or the airwaves. And unfortunately, we live in this sort of social media world, and they're humans too, right? They're also sort of, suffering with the same dopamine addictions that most of us are. I think there's that second element. And then third, I think there was quite a few of these frauds and scams and so on and so forth, which kind of came to the limelight. So, there is an element of paranoia. Now, what you do is you overlay this sort of this view that, hey, the shift towards digital cash, is going to, make us weak as regulators, which means we want to increase surveillance, right? And so therefore we're going to slow everything down till we really understood what we are surveilling, I think has been the function. And I'm not defending the regulators. I'm just trying to explain what I come across every day when I sort of advise regulators, and I tend to work with quite a few of them. But there is a question here, and I think there's 2 questions here. I think, and one is a very interesting one for you. I'm not suggesting the other one is not that interesting, but do you think that this increased surveillance will sort of come at the cost of privacy? Right. And one could argue that, have you ever lived a very private world, and do we live a private world anymore? But do you think, how do you kind of strike a balance between some level of privacy left and, the regulators want to sort of surveil everything now to the nth degree, and the digital form factor makes it easy to surveil, right? So, for example, retail CBDCs is a great example, right? Where a lot of people think that it's actually the big brother tool rather than anything else.
Arjun, I don't know about you, but I think that we carry around surveillance devices with us voluntarily, and we stare into them for, 5 to 10 hours per day. And there are definitely use cases where there's a technical challenge on the blockchain that people look. If we're two businesses doing, if we're businesses doing B2B transactions with each other, we are not going to be publishing those transactions on a public blockchain for everyone to see, because once we're doxed, once somebody knows that this address belongs to Arjun, then they know all of your previous and future transactions. That's not cool for businesses or institutions. It might be perfectly acceptable for me as an individual to have these transactions going along in a public blockchain with the risk that I get identified at some stage. I would hope, interestingly, in the blockchain trilemma, privacy isn't one of the aspects of the blockchain trilemma, but there are many use cases that transaction privacy is definitely required. Personal privacy, I guess I don't see a meaningful difference between. It's a little bit like the question of quantum computing. People say quantum computing breaks Bitcoin. Well, quantum computing breaks traditional finance a lot faster than it breaks Bitcoin. So I suppose that I don't see a meaningful distinction between privacy on these new infrastructures versus all of the other surveillance technologies that we live in the middle of. If there's a way of becoming invisible in all of that stuff, Arjun, please let me know.
It'll be the next. Well, it'll be my startup then, not yours. Because I guess I'm getting to that age that if I don't do a startup now, I'll never do it. And I think I've kind of learned how to live vicariously through other people's successes and failures. So I think
I've got some great ideas.
All right. I think we should definitely, when I'm in London, because London is home for me, whenever I'm in London next, I will definitely come, and maybe, you can get me enthused enough to sort of do more than a podcast these days. So here's my last question, and Tony, we could go on because this is great for me. I'm lapping it up. I'm learning a lot. So we're going to come back to Ubyx, right? So where are you in your journey, right? And you briefly mentioned it a little bit earlier in terms of that you've just done a raise, and congratulations for that, right? What are some of the sort of notable, interesting pilots that you are currently sort of working on that you're happy to share, and how do you sort of see this moving forward in terms of how do you get this adoption for Ubyx? What's the route to, if I may say, scale, if I use that term?
Yeah. So I think every startup begins with a thesis, and I published my thesis in the white paper. It's there for all to see, and then I tried to attract external capital to prosecute that thesis, and then I do that. So then I build a team, the people who've got the skill sets to do that, and then we build a product. We're looking to go live shortly, and again demonstrate that thesis. So you've got to first make the machine work, and then you have got to get what they beautifully call product market fit. And the money that you raise is your rocket fuel, and either you reach space or you don't. So I like to take as scientific as an approach to things as possible, which is if you're a scientist, you examine a thesis, and then evidence is the experiment, and evidence is the test of that thesis, and you either falsify it or you prove the thesis.
And when you say product market fit, so your market is evolving, it's shifting all the time. I think your market itself is kind of forming. So how do you achieve that, right? Are you going to go through some pilots? Are you working with a few, if you can share names, great. If you can't, are you working with a few sort of providers?
Yeah, we have a bunch of folks who will go live with us on the issuer side and on the receiving side. And then once you have 2 issuers and 2 receivers, and then you keep adding, then hopefully that kind of a network scales quadratically and has the potential to scale very rapidly if we don't screw it up. But humans screw you know what? There's a really good resource, I think, for anyone in this space, which is, have you seen the movie Zorba the Greek? Zorba the Greek. It was a very famous movie with Anthony Quinn, and essentially this Greek guy comes up with a cockamamie scheme for moving lumber from the interior of a Greek island to the port. He's going to make millions of dollars from doing that, and they build an elaborate contraption to do that. At the very end of the movie, and I'm sorry to ruin it, they start sending the logs down on this elaborate contraption, and it completely falls apart. And then the guy starts dancing on the beach, because man proposes and God disposes. So there's only so much that you can control. You control what you can possibly control. And at the end of the day, the world will decide whether or not the thesis is good or bad, and whether or not we are the people to execute it or not. So, well, that's the rocket fuel, isn't it? That's the money that you raise is your lifeline to have enough time to reach that escape velocity. And either you make it, or you have as Elon Musk says, a rapid unscheduled disassembly.
No, I do. But, in the world of fintech, we've seen, rocket fuel come along for longer than one ever anticipated. And, simple ideas take much longer than one expected. And then some of them have actually turned it around and, voila, they finally achieved product market fit. So I think my question was more in terms of, personal sort of drive and desire, in terms of, a lot of people will say that, I'll do it as many times as it does to get it right, because I believe in my thesis. And I do think that there is an essence of it, right? And there will come interesting pivots along the way. And I think there will come interesting offers along the way. And I guess, your scientific approach will become quasi-scientific and quasi sort of commercial, right, somewhere down the line, because we are, I guess, having worked with quite a few founders, who've had sort of passion and vision and so on and so forth, somewhere down the line they need to be sort of shaken up and said, believe in your idea, but sometimes you got to sort of smell the coffee. And I'm not suggesting you need to smell the coffee, but it was more of a passionate question, because I think this sector is going to change so much in the next few years that I think finding product market fit isn't going to be, if I may say, easy. But I also think a lot of money is going to be available, right?
Quite possibly. And I'm an older founder, Arjun. I'm 55 years old. I'm 55 years old, right? I worked in traditional finance for 30 years. So I was also a relatively old father, right? I had my son in my 40s. And I would like to think that by being a slightly older founder, I can look upon this with a slightly more detachment and, dare I say, amusement than if I was in my 20s. So I will do my level best to prosecute the thesis along with my team, and we will see how the world reacts to it. And if it turns out that it's true, beautiful. If it turns out that it's not true, or we're unable to prosecute it, c'est la vie.
No, we're going to all stand by the sidelines as cheerleaders. Well, I'm not a very attractive cheerleader, but definitely who's big and can make a lot of noise, right? Why not? Why not? I think, what's good is you're trying to solve. I read your thesis when David shared it. It's well written. It's solving a real problem the way I see it. Obviously, it only becomes bigger and bigger as this part of the world sort of becomes more and more formative. I think in the last 6 months to a year, you must be sort of quite assured that this is now going to become a reality, because I think 12 months ago, who would have known any better, right? Or at least some of you knew it better. People like us didn't. So, wishing you the best of luck. I'm sure it will be a success. And my only word of advice would be, don't ever say no to anybody, because who knows, what the next turn brings. That's one. So I'm not going to slap you for anything, right? I will encourage whatever action action you take. And you know, who knows, if you ever make it to this part of the world, or I don't know if you're coming to Singapore later in the year, for Singapore Fintech Festival, it would be a pleasure to sort of meet in person and say hello.
For sure. All of the above. I can, it'd be a delight to do so.
Tony,
thank you very much.
I thank you. And I, thoroughly enjoyed it. And I'm sure the audience will, because I think you simplified some complex ideas, which most of us can walk away and sort of say, oh, okay, now we get what people are talking about. So with that, I'd like to say thank you and see you soon.
Much appreciated. Thank you so much.
Ladies and gentlemen, that was Tony McLaughlin, who is the founder and CEO of Ubyx. This was an interesting discussion, and I'm sure you'll enjoy hearing into it, because it wasn't in the crypto language as some of the other episodes are. This was spoken in, I guess, simple parley. But with that, I'll say goodbye till next week. Bye-bye.